before you can control someone, you must have power. So if you have power, what it means is that you actually have existing rights. You have existing rights that give you the current ability, that gave you the current ability to direct the relevant activities of the company. So if I have power, what it means is that I have some right, I have some existing right that gave me the ability to direct the activities of another company. That is what we mean by power. So if I don't have power, I can't have control. So control means that we said control, you have access, so you have right. If you have right, it means you have power. So under this, we know that control means you have power. So now, if control means you have power, it means you can decide to say that you, together with other investors, can direct other businesses. So two investors or two or more investors can collectively have control, collectively control another business, control another business. So if I have Isaac, I have Benedicta, and myself, we come together and we bring our percentage together, our percentage of holdings together, we can have control over another business. I have control over our business. But we said that we can only have control if you have power. And this power must come from what? Your rights you are having. So you must have power. And this power must come from the rights you're having. Now, when we talk about, you heard me saying variable returns, this word, variable returns. When we say the variable returns, they refers to the benefit that we will derive from the investee. So if they are positive returns, we will be entitled to. If they are negative returns, we'll be entitled to it. So whether positive, negative, or only negative, positive only, we are saying we have access to them. So if you have control, it means you have access to direct the variable returns. If you have power, it means this power is coming from your existing right. So let me type here and say that power is arising from, or is power arises from existing power. Sorry, existing right. Right. That is what we have. So in a business, you can have people who are minority holders, minority interests. And we said this minority interest, we call them non-controlling interest. Non-controlling interest. And we also have the parents too. The parents too as well, parents. So you should be able to identify whether indeed there is power or there is no power. That is what you must note. Now, you heard me talking about consolidation. Consolidation. That when you have control over another company, control over another company or another business, that business, that business becomes your subsidiary. That is what we established. Subsidiary. So if you have your subsidiary, what it means, you now parent needs to consolidate, needs to consolidate its resource with that of the subsidiary. Note that of the subsidiary. So if it is consolidating, it means it is adding up. Consolidating means it is adding up the figures. So its figures, that is to the parent's figures. So what it means, you are adding the subsidiary figures to the parent figures. So for example, if you have parents here and you have a subsidiary here, and then you come back and then you tell us that you have assets. So let me push this one to the other side. You have assets, and the asset parent is 10,000, subsidiary is 5,000. You have liabilities. Parent is 2,000, subsidiary is 1,000. You have equity. Parent is 8,000, subsidiary is 4,000. If you are adding, which means that you should be able to say that the group is the addition of the parent and the subsidiary. So we have 15,000. We have 3,000. But we do not add the equity of the subsidiary to the parent. We don't do that. There is a way to do that. So that one, we will leave it later for another day. I will tell you the ones later on. I'll tell you the ones we add so that they will become equal. So with this, we add the parent asset to the subsidiary asset and show it as one. And the group we are showing is the consolidation. Consolidation. So we add the parent resource to the subsidiary resource and show it as what? As one. And we show it as one. But we don't add their equity. We only show the parent equity and add other things to it. So what happens here is that, as I said, we add the parent, but the only thing we don't add the subsidiary equity. Kindly note, don't add the, because that is what you are going to purchase. So we don't add, but there are certain things we add. So what are the rules of consolidation? So let me now come back to the rules of consolidation. Let me go in them and then show you the rules of the consolidation. Consolidation. Okay, let me just be here and just type it for you to see. If you want to consolidate, the rules of consolidation. You combine like items of the parent asset, liability, equity, and that to that of the subsidiary. So we combine. So I've typed it here by saying you combined like items. You are going to combine like items of assets, liability, equity, income, expense, cash flow of the parent, and those of the subsidiary. Then what will you do? You eliminate you try as much as possible to eliminate intra-group transactions. You try as much as possible to eliminate intra-group transaction. So when we say you introduce intra-group transaction, or we are trying to eliminate intra-group transaction, if parents sells to subsidiaries, that is A selling to B. A selling to B. Because A sold to B, we need to eliminate that transaction from the books of account, because I'm going to add A's figure to B's figure and present it as consolidation. So it will not be good for you to say that you are going to include the goods that was sold by the parent to the subsidiary. So anytime the parent sells goods to the subsidiary, or the parent transfers assets to the subsidiary, we eliminate it. We eliminate it. So always intra-group transactions are eliminated. Intra-group transactions are eliminated. That is what you know. So if company A sells to company B, or company B sells to company A, so note that if parent sells to subsidiary, or subsidiary sells to parent, sells sells to sells goods to, so let me, goods to subsidiary, or subsidiary sells goods to parent, they are all intra-group transactions. They are intra-group transactions. So when the parent sells to the subsidiary, we will call it downward stream or downstream. Downward stream. Downward stream. But if the subsidiary sells to the parent, it's upward stream. Upward stream. So that is it. So if the parent sells to the subsidiary, or the subsidiary sells to the parent, we eliminate this intra-group transaction. We eliminate the intra-group transaction. That is what you must note. But again, if you want to consolidate, I said we should combine like items too. You should eliminate intra-group transaction. Then we have the third one. Ensure that they have the same or similar accounting treatment of the transactions. So we will call it uniform accounting policy. So the third one, there should be uniform accounting policy or policies. So you can say you are going to combine the results. We can say we are going to combine the results of Unilever Ghana with that of GCB. You can't do that because they have different accounting policy. So because they have different accounting policy, we do not include them. We do not include them. So uniform accounting policy before we can consolidate. That is what you must know. The fourth one is that they should also have the same reporting date. reporting date. They should have the same reporting date. So one cannot be 31st December and the other one will be 31st March. So let's say one starts from 1st April to 31st March. No, they all should be 1st January to 31st December. So we should have a uniform accounting policy. They should all have a reporting date. Then also, when you are consolidating, ensure that you also show non-controlling interest. Non-controlling interest. So always ensure that you are able to know the non-controlling interest. You get to know the reporting date, you get to know the uniform accounting period, and then as well you eliminate intra-group transaction. Any question? Any question? Yes, sir, Isaac.
Please, when you were talking when you were talking the people, where you added the parent entity to get the when you got to the equity, you did not add them up. You said there is a way of
Yes.
adding to get them, but when you look at the rules of consolidation, the first one is combine like items of assets, liabilities, equity.
Yes. We do that. So yes,
Like that
yes,
way.
yes.
Okay.
So at the equity side here, we will add the parent own. We will we will add the group retained earnings. The group retained earnings. So we have group retained earnings. So that is what we add. You add non-controlling interest. Non-controlling interest. That's the reason why I said that when we get here, we need to hold on because there are things that we need to add. So you're not going to add the subsidiary capital, no. But this is what we are going to do. And this week, we are not going to do any calculation. The calculation will start from unit 3. That is next 2 weeks. So I'm just introducing you to the theory and share the document with you. You can do that. So Isaac was saying, why didn't I add the equity item over here for that of the subsidiary? Because in my slide here, I typed here by saying that, so let me go there. You're saying that when I was typing, I wrote combined like items, that of the subsidiary and then that of the parent together and presented as one. And I made mention of equity here. And I was saying that I can't do that. But if you want to do that, you only have the group retained earnings and that of the non-controlling interest. That's what we do. But this week, as I said, we are not going to do any computation. We are just doing the theory. Now, the last thing that I want to do is if A has purchased B, sorry, let me make it D because that one is better. D has purchased D, but the percentage of holding is between 20% to 50%. It means A has significant influence in D. In that case, D becomes an associate. But if A and Z comes together through a joint arrangement and they decide to have a different business called Y, the process they went through is joint arrangement, but they decided to have a business called Y. That Y becomes a joint venture. A joint venture. Now, A and Z have joint control in Y. So they have joint control in Y. I also said if A and O comes together, they want to undertake an operation, and they want to undertake an operation called election. That is the military and then the police. If they want to undertake an operation, when they bring their resources together, they undertake the operation. That operation they are going to undertake is election. That, because they are bringing their resources together, we call that operation joint operation. And this morning I told you that if Ghana have gas pipeline, Nigeria has gas. Ghana will now collaborate with Nigeria that we want gas in Ghana here to sell to consumers. What do we do? So what to do is that Nigeria is okay, since you have gas pipeline and I have gas, let's use your gas pipeline to transport the gas to Ghana. So that if there's a problem with your gas pipeline, Ghana will deal with it. If there's a problem with the gas, Nigeria will deal with it. So when they deal with that, because they don't have asset, no one is entitled to the asset of the operation, we call that one a joint operation. But when A and Z comes together and they form a joint venture, no one is entitled to the assets and liabilities of the joint venture, because we contributed and we said we are going to form a new business. So in that new business, maybe because I provided 80% and maybe Isaac provided 20%. So Isaac will say that because Saima has 80%, Saima has majority holdings. No. So I'm entitled to all the assets. No. If it is profit, I'll take 80%. If it is profit, Isaac will take 20%. But in terms of the assets and liability, we don't have rights to them. But with a joint operation, we have rights to the assets and liabilities. So all the parties to the joint operation have what assets to the rights and liability. And I also give example like the pump station, the fuel station. Someone has a fuel station, has a pump stand, and then will ask that, okay, Ghana Oil, please, can you provide me with fuel for me to sell? So the tankers, when they are supplying the oil, what it means is that the Ghana Oil will be in charge of controlling the tankers. If there's a problem with the tankers, they will deal with it. But the one at the fuel station also is in charge of the pump. If there's an issue with the pump, he deals with it. But what they are doing is they are having what a joint operation. So that's how I can explain the issue. But this agreement comes as a result of a joint arrangement, and this joint arrangement is governed by a standard called IFRS 11. IFRS 11. But with A going to D having a significant influence is governed by a standard called IAS 28. Now, if you are dealing with associates, we do what we call equity accounting. But if you are doing joint venture to, you are using the same equity accounting. That is what you must know. There's a process we need to go through, but just the equity accounting method is just trying to know your value of your investment plus any profits from the investment. That is it. That is the equity accounting. So let's say, for instance, you have 20% holdings in Unilever. So your value is the 20% plus any profit that Unilever will make will add up to your value. So that is your equity accounting. So if A and Z have interest in Y, the joint venture. If the joint venture makes profit, A is entitled to his percentage of the profit, and then Z also is entitled to his percentage of the profit. That is all. All right. So so far so good. I've shared with you the link we have for the semester. Let me show you again so that you can address yourself with the issues we are having. Today we met the chief. We had an emergency meeting, as I told other people here that we had an emergency meeting with the chief examiner. The chief examiner is requiring us to use the document she had shared with you. So we are all going to use the Google Drive. So if you have any information or if you need any information, you go there, you get it from there. So in the Google Drive, you all have access to it. You just go and then look at Unit 1 materials. Then you see all the topics we are dealing with over there. So Session 1, Session 2, Session 3, Session 4, 5, and 6, they are all reading. I expect you to go through. And I've talked about all of them, just that I didn't open the sessions for you to see. But all the issues, Session 1 is about company act. That one I've dealt with it. Session 2 is about separate financial statements. I've made mention of it. Session 3 is our business combination. I've talked about it. Session 4 is consolidated financial statement, where I just started and I was talking about this parent, subsidiary, how we do business combination, and how we do consolidation. I talked about that. Then I went further to talk about eliminating intragroup transaction, and as well to recognizing uniform accounting policy when you are consolidating. That is Unit 6. And Unit 6, I talked about investment in associate and then joint venture. So these documents are there. You need to go back and then read them. We will we are going to add slides. We are going to add video links. We are going to add sample questions to assist you this semester. So this semester, we are not alone. We are all working together with the chief in this course, and we expect that we perform well. The model I shared, the model that was shared at your various centers, please, that model, for now, you can keep it as a reference material, but we are going to use these ones for the semester courses. Any question from you?
Yes, sir. Good
Yes.
morning, good afternoon.
Good afternoon.
Yes, sir. Just a suggestion that I would like to make.
Okay.
Yeah, I would like us to create a WhatsApp page so that those of us joining this particular or that under your tutorial will be in the group so that you share the models and then the tutorial with us.
Okay, so we already have a WhatsApp page that is uh, accounting for accounting students who are doing this online. So I'll reshare it again here with you for you to join.
Okay.
So I'll add it to the chat box. You can go there and then click on it. Then you can have access to the page. That is where I will share all the documents there. And those I'm teaching face-to-face to the Lutra Madina student to, I will share your documents with the course rep. So I have face-to-face students joining me at 11:30 on Sundays online. And then I have other students too, who also are joining me online throughout. So centers, I know I have centers. We have STU. Many people are joining me here. While people are here, Fiasanai, Enchi, Bompe. For Boutek, Soko Day, that is who, and Kita, Beard Accounting, they will join Foster for their online lecture. Right.
Okay.
Yes.
Okay, so this is Keta. So it's
Keta.
supposed to join Foster.
You are supposed to join Foster. But you can still join me. But when it's presentation, you have to, during the presentation, you have to go and join Foster for him to record your score.
Okay, sir.
Right. Thank you.
Thank you so much.
You are welcome. Any other question from anyone? Okay, so I'll make available the recorded version of this class together with the morning class as well with you. Thank you very much for your time. We'll meet. The group WhatsApp page is on the message box. Kindly go there and then just join. Just join. Thank you, and then have a good day.